Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Sally Beauty stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Sally Beauty is a retailer and distributor of beauty supplies. The company is headquartered in Denton, Texas. It was founded in 1964. It went public in 2006 and trades on the New York Stock Exchange and Deutsche Börse. The company sells and distributes items through over 4,000 stores, including 200 franchised units, all around the US, UK, Belgium, Canada, Chile, Peru, Puerto Rico, Mexico, France, Ireland, Spain, Germany, and the Netherlands. It sells 6,000 products for hair, skin, and nails through professional lines such as Clairol, L'Oreal, Wella, and Conair, as well as proprietary merchandise. Let's get started with the model. This is a mid-cap company, 2.5 billion market cap. They're trading at 22 a share, and they have 113 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see that free cash flow is moving upward from 286 million up to 416 million. Net income is the profit and loss of the income statement. It's revenue minus expenses. And that decreases from 258 million to 142 million. Revenue is the sales for the company, which decreases from 3.9 billion down to 3.5 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, which has been decreasing from 1.9 billion down to 1.7 billion. Below that is operating expenses. Examples are marketing and depreciation. Gross profit minus operating expenses gives you your operating income, which has also been decreasing from 2018, but it has increased from 2020. Below that is the interest they pay in their debt. They paid the most interest in the trailing 12 months at 105 million. Below that is other income and expenses, which are usually asset impairments or the gain on asset sales. Then the bottom line of the income statement is their net income, which has decreased from 2018 and 19, but it is up from 2020. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. So you can see that operating cash flow looks really good from 372 million up to 482 million. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And their free cash flow looks pretty strong year to year. Since they have extra cash each year, they've been buying back stock. They bought back 167 million in 2018, then 47 million, then 61 million. Every time a company buys back stock, that decreases the shares outstanding, making your shares more valuable. There's two main ways to reward investors: pay a dividend or buy back stock. This company does not pay a dividend, but they do buy back stock. They added about $200 million of debt in 2020. Although in the trailing 12 months, they paid down $350 million of debt. So instead of buying back stock, they were using that $416 million of free cash flow to pay down debt. Let's look at the capital structure. 135 million of equity, 2.1 billion of debt. They're 6% equity, 94% debt. So this company is really leveraged. They're using debt to grow their business. And their net debt is 1.7 billion. Net debt is total debt minus the cash on their balance sheet. Their WACC is 9.75%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 4.9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.5 billion. We divide that by 113 million shares. And we get a calculated stock price of $40. They're trading at $22, so they're trading at a 43% discount. It's a strong buy according to the model. Simply Wall Street values them at $24, so they're saying the stock is slightly undervalued. 6 analysts priced this stock, and the average stock price was 26. The low was 23, the high was 28. This top chart is the stock price since it started trading. So it looks like in 2006 it was fairly flat for a while. Then the price was driven up to close to 35 a share. Then it decreased for a few years, but in the past few months the stock has more than doubled. This is the stock price the last year, so it looks like it's done really well. So you could have made a really nice return if you bought the stock down here. They have a pretty high beta, 1.64, so the stock moves about 1.5 times the market. The stock has gone up 47% in the past 52 weeks, while the S&P 500 went up 35%. The 52-week high was 26, the low was 828. The stock is trading above its 50-day and 200-day moving average, so it seems to be on an uptrend. About 1 to 1.5 million shares are traded each day on this stock. Of the 113 million shares outstanding, 94 million are on float. Most of the shares are held by institutions. It has a really high short percentage. Over 20% of the shares on float are shorted. In the past year, this stock has gone up 47%, its industry 80%, and the market 44%. In the past 3 years, this stock has gone up 48%, its industry 95%, and the market 61%. But in the past 5 years, this stock has struggled, down 25%, its industry up 123%, and the market up 121%. Analysts are forecasting their earnings to increase 26%, its industry 23%, and the market 15%. Analysts are forecasting their revenue to increase 3%, its industry 10%, and the market 9%. In the past 5 years, their annual earnings decreased 8%, its industry increased 8%, and the market increased 12%. In the last year, their earnings decreased 31%, its industry increased 100%, and the market increased 20%. If you invested $10,000 into this company 10 years ago, you would have doubled your money after a few years, but if you're still holding on, you'd be at $13,800 today. That's a 38% total return, a 3.25% annual return. The biggest shareholder is BlackRock at 16.5%, then Arrowmark, FMR, Vanguard, and AllianceBernstein. Let's look at their financial ratios. The average PE in the market is 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 17.8, so investors are paying about $18 for $1 of earnings. That's better than the market median and average. They have an amazing price to sales of 0.7, much better than the market median and average. Price to book is stock price over book value per share. They're at 18.8. That's not such a great ratio. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have 135 million of equity, negative 467 million of tangible equity, since they have 602 million of intangible assets on their balance sheet. They have a 12.1% return on invested capital. Their interest coverage ratio is close to 3, so they can cover their interest payments about 3 times. They have a really high ROE at 105%. That just shows you how you can inflate your ROE if you take on a lot of debt. And they have a good current ratio at 1.7, so they can cover their current liabilities with their current assets. Their current assets are 400 million of cash and 950 million of inventory. They seem to be well capitalized. They had over $400 million of free cash flow, nearly $600 million of working capital, so they have over $1 billion of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 11 companies in the same industry as Sally Beauty. And if Sally has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're doing a lot better in PE and price to sales. They're a little worse in price to book. They're doing better in current ratio. They have an amazing ROE because they have so much debt. They're 94% debt. And their market cap is smaller than average. They're 2.5 billion, average is 7.7 billion. They do not pay a dividend. A handful of companies in this industry do pay a dividend. To summarize, I have them trading at a 43% discount. There's always going to be demand for beauty supplies. You just have to figure out the company that's going to be around to supply that demand. This company has been around a long time. They have a good brand name and a significant following. Each year they seem to be putting up good and consistent numbers. It seems like a stock that's a good long-term hold. I rank their free cash flow 7 out of 10, their revenue 6 out of 10, and their ratio 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, You can become a member by clicking on the link in the description below. Thanks for watching.